Ever feel like the stock market is this big, complicated thing that's impossible to understand? Well, today we're going to demystify it, and we're going to do it with a simple story about one very smart monkey and a whole lot of bananas.
You know, every great company on Earth started with just an idea. So let's meet the entrepreneur at the heart of our story.
So, meet Monkey. He's noticed something. There aren't enough good bananas in his part of the jungle, and he has a vision. He's going to build the greatest banana business the world has ever seen.
But there's always a catch, isn't there? Monkey has this brilliant idea, he's got all the ambition in the world, but he is flat broke. Not a single coin to his name. So what's he supposed to do?
This right here, this is the moment where our whole explainer really kicks off. Because Monkey's solution to his money problem, well, it's the very foundation of the entire stock market.
Monkey has a genius idea. He decides to sell tiny little pieces of his future banana business to some of the other, richer monkeys in the jungle. They give him cash now to get started, and in return, they get to own a small slice of the company. That transaction, that's what a stock is.
Now, why would these other monkeys just hand over their cash? Well, because they're now part owners. They get a cut of the profits. So when the banana business does really well, Monkey shares that success with his investors. These little payouts are called dividends. Everybody's happy.
This is a good time to clear something up that confuses a lot of people. Think of the stock as your ownership in the entire company, the whole banana tree. A share is just one single unit of that ownership, like one single banana. So the more shares you own, the bigger your piece of the tree becomes. Simple, right?
And just like bananas, not all stocks are created equal. You have blue chip stocks. These come from huge, established companies. They're reliable, they're steady. Then you've got penny stocks. These are from tiny startups, just like Monkey's business was at the very beginning. They're way riskier for sure, but the potential payoff could be absolutely massive.
Okay, so Monkey got his funding, and his business is off the ground. But where do other monkeys go if they want to buy a piece? Or if his early investors want to sell? That brings us to the bigger picture, the market itself.
And here it is. Welcome to the stock market. In our story, this is like the big, bustling marketplace in the center of the jungle. It's where all the different monkey companies are listed, and it's a place where anyone can come to buy or sell shares in any of those businesses.
And you know what? The market has moods, just like monkeys do. When prices are generally on the rise, we call that a bull market. Think of a bull charging forward. Everyone's optimistic, feeling good. But when prices are falling, it's a bear market. And yeah, the mood gets a lot more gloomy.
Now, investing all your money in just one company can be risky. I mean, what if someone really does eat all the bananas? That's why investors often like to group stocks together, for safety in numbers.
And that's called a fund. It's basically a pre-made collection of a whole bunch of different stocks. The whole point is that by owning many different stocks at once, you spread out your risk. You're not just betting on one single monkey's business to succeed.
A classic real-world example of this is the S&P 500. So in our world, we'll call it the Monkey S&P 500. It's a fund that holds stock in the 500 largest and most successful monkey companies in the entire jungle. Yeah, that's right, 500. We're talking about the biggest of the big, the most successful companies out there, all bundled together into one single investment. The whole strategy is built around diversification.
And that's what diversification is all about. By investing in just that one fund, you get a small piece of everything. The best fruit companies, the most innovative bug businesses, the sturdiest tree suppliers. So if the banana business has a bad year, maybe a booming bug business helps balance everything out.
Now, there's another type of fund out there called a hedge fund. These are a different animal entirely. They use much more aggressive, much riskier strategies to try and get huge returns. But because of all that risk, they're generally pretty exclusive, only for the richest monkeys, basically.
But why do the prices of these things go up and down so much? I mean, really, what makes a piece of the banana business more valuable one day and less valuable the next?
Let me give you a perfect example. Step 1, the Jungle Times newspaper reports a possible banana shortage. Step 2, all of a sudden, every monkey wants to get their hands on bananas, so demand just skyrockets. Step 3, because Monkey's business sells those bananas, investors think it's about to make a ton of money. So they all rush to buy the stock, which drives the price way up. It's pure supply and demand.
And really, there are countless other reasons. Good news, like the business expanding into new jungles, that'll raise the price. Exciting news, like a rumor about a secret new banana recipe, can do the same. And of course, bad news, like a rogue monkey eating the entire inventory, well, that's obviously going to make the price crash. So we've covered a ton of ground. We've talked stocks, shares, bulls, bears, funds, the whole shebang. But before we finish up, there is one final absolutely critical thing that you have to remember.
And here it is. This explainer is just for fun, just for educational purposes. Now that you understand how it all works, you should always consult a qualified professional for any actual investment decisions. And really, whatever you do, don't sue the monkey.
Thanks for watching The Explainer.